If you're scalping on the 5-minute chart and struggling to stay consistent, it's not because the strategy doesn't work, it's because you're entering at the wrong moment. This strategy will change the way you enter trades forever by helping you stop getting trapped while others keep losing money. It's built on 6 simple steps. We'll break them down one by one, and by the end of this video, you'll have a clear, structured, and highly effective trading system you can apply immediately. Here are the steps you will learn to master this strategy in this video. How to identify the right market context. How to spot a high probability flip level. How to identify the inducement behind the move. How to recognize the bait and switch that traps most traders. How to confirm the setup using volume. And finally, how to execute the trade with precision. I'll also walk you through a real chart example, so you can see exactly how to apply this strategy step by step in the market. But here's the important part. If you miss even one of these steps, you won't be able to use this strategy correctly because every part plays a key role. So make sure you watch this video until the end, because this strategy could completely change the way you trade. Before we get started, if you want more videos like this, make sure to like, subscribe to the channel, and hit the notification bell so you don't miss any new uploads. Let's start with the first step, identifying the right market context. Whenever you open a chart, you will usually find 4 main market conditions: an uptrend, a downtrend, and a range. Each market condition requires a different approach, and that is exactly what you will learn step by step in this video. Let's begin with the uptrend. An uptrend is simply a market that keeps making higher highs and higher lows. This tells you that buyers are in control, and the market is moving upward. Now pay close attention. When the market pushes up, creates a higher high, and then starts to retrace, the level where the retracement begins acts as a resistance level. If the market later comes back, breaks above that resistance, and then turns it into support, that level becomes very important. And this is exactly what we mean by a flip level. A flip level is when a previous resistance level becomes support. Once this happens, that area becomes a very hot point in the market, because it often attracts attention from both buyers and sellers. So, when the market returns to that level again, there is a strong probability that price may react from it and continue moving higher in the direction of the uptrend. So now you understand the first step, which is identifying the right market condition, and the second step, which is spotting the high probability flip level. Now let's move to the next step, identifying the bait and switch. The market comes back to the level, moves down, and breaks below it, giving traders the impression that the market is about to go lower. But instead of continuing down, price quickly reverses and closes back above the level. This is what we call a bait and switch. When this happens during